Hello and welcome back to Live from Our Living Room. I'm joined today by Elliot Hentov, the head of macro policy research at State Street Global Advisors, to discuss a wide range of global economic challenges. Elliot, thanks so much for joining me.
Thanks for having me.
So we're in the fourth calendar month of the war in Ukraine, and the impact has been enormous. I mean, casualties among combatants and Ukrainian civilians are in the tens of thousands. Millions more have been displaced. But the impact of the war is perhaps more far-reaching and more global than many might have anticipated, especially in food and energy markets. Let's start with energy. The European Union authorized an embargo on most Russian crude oil products last week, which is an incredibly harsh penalty against Putin's war machine, but may prove an equally harsh penalty for European and global consumers. So what's happened to the price of oil since that announcement?
Well, I wouldn't get too carried away by short-term movements in the price of oil. What matters really is that the war is not ending. There's no end game in sight. And as a result, we're not going to get a relaxation of the stress on the energy system. So what has happened is the war has basically pushed up the floor of how low energy can actually drop, even when it goes through its cyclical movements. It's the last couple of days or last week, it was quite elevated. In the near term, we expect some energy prices to drop as global demand slows down, as the economy globally starts to stutter a little bit. But energy is not going back to 80, 70, or $60 a barrel. If at all, it'll sink down back to 100 or slightly below that. So the floor has been lifted, and that means that stress that energy does not only on for consumers at the pump, so to speak, but also on globally, on terms of trade of economies, on currencies, all of that stress in the system stays there. And that's one of the things that's kind of a little bit of an anchor on the global economy today.
So what I'm hearing you say is that the war in Ukraine is the primary driver of this fluctuation in oil prices. OPEC, the global cartel that is largely responsible for setting oil prices, announced last week that they plan to increase production in June and July by modestly more than many analysts anticipated. But you wouldn't say that that will have much of an impact on stabilizing prices, right?
Well, this is where you get the spillover directly from geopolitics to energy back to geopolitics, because OPEC Plus is, at the end of the day, is almost a geopolitical arrangement between the big Middle East oil producers and Russia. And they're facing off with the other large big oil producer, which is the United States. Now, the result is that given the geopolitical alignment, supply is not being stepped up from this OPEC plus block sufficiently to really bring energy prices down. So the only real major hope in the near term is that US production starts to accelerate beyond current market expectations. That's the only real hope for energy prices. And one thing to point out, the war in Ukraine is having a debilitating effect on Russian oil production. It's not only the embargo, it's the sanctions on capital goods, on high-tech equipment that is needed to replenish rig operations to expand production in a variety of kind of more complicated oil fields across Russia. So what you're getting is a combination of kind of financial sanctions, technology sanctions, economic sanctions. That's pushing Russian oil production structurally down month by month, year by year. And so even if OPEC Plus, which is the combo of Russia and the Middle East, were to say, let's raise our production caps a lot, the Russians would not be able to contribute to that boost. So it would all be largely the Gulf producers that would have to step in. So that too makes it a little bit less likely as an outcome.
We've also heard rumors that the Biden administration is seeking alternative sources of energy from former adversaries, Iran and Venezuela. The Europeans are doing the same, seeking out partners that they haven't sought out in the past. Can that make up at all for the shortfall?
It can help. I think shortfall is a big word here, and it depends what we're talking about. But the Iranians could contribute at least another 1 million barrels a day of supply on the global market. Venezuela could probably ramp up half of that. And so together, that's quite a substantial amount. It doesn't fully fill the gap, but it would be sufficient at least to stabilize prices at a lower equilibrium and a little bit more tolerable level. The question, what are the prospects of that? The problem with Iran and Venezuela, these are hardened relationships. These are long-standing confrontational adversarial relationships, and although the timing is good for a rapprochement, the issues are very difficult, and so the expectation is that very little will actually happen in terms of oil being produced and shipped to the global markets, at least for a few months, in the best case of scenarios.
Let's turn to food markets. I hope you have better news for us here. Russia and Ukraine are two of the world's largest exporters of grain, and according to the UN, the war will almost certainly lead to a major food crisis. In the West, disruptions in food markets will be mostly paid for in higher family expenditures. In developing countries, these disruptions will likely be paid for in lives. So what steps are being taken to deal with this crisis?
Yeah, this is also quite a depressing topic. I think I'll just, for context, before the war started, global food prices were near all-time highs. So we, even in the absence of war, would have had a very difficult year just in terms of the belt tightening effect that high food prices would have on poorer countries and lower income households. The war not only added a price shock, but also a supply outage by curtailing some of Ukraine's production, some of Belarus and Russia's fertilizer exports, and most importantly now, by blocking shipping routes for large chunks of the harvest that took place. Again, the bad news here really is that there is no relief in sight, because not only is the war not ending, some of the harvest and planting season has been disrupted. So next year's output will be lower too. So that's already kind of baked in. And in contrast to energy, there's even less swing capacity in terms of agricultural supplies. Now, the one good news here is that you can substitute wheat for other grains, and you can substitute grains for other food. So there's a little bit of absorption capacity in global markets, but that assumes certain economies and are able to switch to, let's say from wheat to something as far as rice, for instance. That's typically not the way these economies operate, but that's a little bit what would buffer it. But otherwise, the news is bad. It's quite dark. We've seen cases like Sri Lanka where they defaulted on debt in order to still be able to make payments for food imports. We've seen India limit export restrictions on its wheat, Indonesia on palm oil, and more of that is to come. And so some countries, Chad just declared a food emergency. We're at the beginning of that cycle. So I would expect over the coming months, many more countries to issue similar emergencies, and hopefully for the world to be able to step in and fill that gap.
How else might a food crisis impact global economic outlook? And while you're at it, you mentioned Sri Lanka. How politically destabilizing could this be?
The answer is both. From an economic point of view, the damage is more limited because most of it takes place in the lowest income countries. So purely just as a share of GDP, it's more constrained. But that, of course, means that the humanitarian dimension is even worse because it affects the poorest people, and you really have malnutrition and other direct side effects. The political consequences are tough to judge. I do think it's fair to say that the Arab Spring, the famous vendor who set himself on fire in Tunisia, was a cost of living frustration, coupled with obviously a lot of other sclerosis built into the system. So here too, I would say political systems that have been very ossified and now encounter a population that basically will have to move or have to agitate to feed itself. That's where you're likely to see it. This is, again, it takes place primarily in frontier markets and lower income countries, but I do expect a few coups d'etats, revolutions, and turmoil as a byproduct.
Inflation in these two markets has caused central bankers in the US and elsewhere to pursue ever higher interest rate hikes. This isn't an easy balance to strike, though, and some worry that in the process of squashing inflation, we might find ourselves in an economic recession. What do you think? Are central bankers working too quickly or too slowly?
Central banking can control one lever. Basically, it can control the lever of demand by making the cost of money go up. They cannot control supply, and they know that. That's self-understood. Now, the problem is that if you think of the total inflation number, what share of that is supply driven? So what share is what you just talked about? Energy prices, food prices, supply chain stress from post-COVID. Now, that share cannot be affected. So central banks have to bring inflation down solely from the demand side. And now when you crush demand, the economic cycle slows down. And so it's really just to me, it's really just a definition question. Will it slow down enough to technically meet the criteria of a recession, which means 2 consecutive quarters of negative growth? And you can almost have an academic debate around it. What's not academic is the slowdown will have to be quite strong to get inflation back down to levels that are tolerable. And that means you'll have something like a near recession or something that feels like a recession over the coming 12 to 15 months in the US, much sooner in Europe and the UK as a result of this.
COVID, like you mentioned, remains a potent driver of higher prices too, especially when it comes to disruptions in supply systems and amid large-scale public health related lockdowns in China. Shanghai's draconian quarantine ended last week after more than 2 months. How long will it take the city's economy to get back up to speed? And can we expect more of these lockdowns going forward?
Yeah, again, I'm sorry you're asking me all these dark questions because the answer here is also quite negative. I think having lived through a cycle of lockdowns and reopenings myself, I think you have firsthand experience too. It's hard to believe that absent increased vaccination and immunity among the vulnerable population, that you will not have repeated bouts of outbreaks of the virus. We're in June now. My expectation is we will have another round of lockdowns and reopenings in China over the course of the second half of the year. I think the bigger question is, when can we see a full relaxation of COVID rules in China? And the earliest is next year in 2023. So until then, another risk for the global economy is that the lockdowns are more frequent or more intense than the latest round was in Shanghai.
How are investors thinking about sovereign risk amid war in Europe and lockdowns in China?
So there was, for the first time in many, many years, there was a sizable outflows of capital from the Chinese capital markets, both on bonds, which is where basically sovereign risk would be concentrated, but also equities. And what's unusual is we've had single month outflows in previous years, but this one actually dragged on for 2 to 3 months. And there, it's a mix of doubts about zero COVID, doubts around the geopolitical alignment as a fallout from the war, a little bit worries about the US-China standoff. But all in all, investors in recent weeks have returned to kind of the riskier parts of the market. And at least from a sovereign risk perspective, China's the risks are almost less in classic sovereign risk, kind of the risk of a default, and more the risk of regulatory intervention that you cannot predict, and that kind of degrades some of your equity investments. Elsewhere, though, what we talked about with energy and prices together rising as they have, it's delivered a terms of trade shock to different parts of the world. And so suddenly some economies are in much worse shape with regards to their balance of payments, and that is going to affect their sovereign risks. For example, a region that was doing poorly was Latin America, but that happens to be a region where energy and food tends to be relatively plentiful. So suddenly there you've basically had a stealth upgrade, so to speak, to some of the sovereign profiles. Whereas in Europe, it's definitely clearly the opposite. If you think of a country like Italy or even Germany, some of the strong ones, this is a negative terms of trade shock that is going to show up.
So investors are returning to China. We've seen a pretty remarkable exodus entirely of Western companies from Russia as a backlash to the invasion, with a fairly significant impact on these companies' growth outlooks. How have investors responded, and what can that tell us about the salience of socially conscious investing?
I would be wary of tying it to socially conscious investing, although I do think it's relevant for the broader maturation of ESG investing, where anything with operations in countries like Russia would have probably earned a low score a priori and prior before the war. The definitiveness or the decisiveness with which Western corporations have cut ties to the Russian market has been quite remarkable, and I think quite without precedent, kind of the rapid departure. And again, at the beginning of the war, it wasn't clear had the war really found a ceasefire within a first few weeks, which was a possibility. Then, in many ways, these assets would have been at bargain prices, and it would have been really a dream entry point. But that opportunity has faded, and now indeed this is kind of a market that's a no entry opportunity. I think the lesson really is broader, that some of the, I wouldn't call it socially conscious, but the broader ESG approach to investing is certainly getting a boost from the crisis, because it just emphasizes how much, a lot of it is simply about managing risks. I mean, that's what ESG investing in some ways is a shorthand, is, companies that score high are managing some of these tail risks of poor governance or risky operations or high carbon footprint. They're managing these risks in a better fashion. And so I think some of that is getting a tailwind as a result of the Russia crisis.
Well, Elliot, not a ton of good news, lots more questions than, definitive answers, but appreciate your time nonetheless, and hope to see you soon.
Pleasure. Thanks for having me.